Dr. P. Sarita, working as Assistant Professor of Commerce. In this video, I am going to explain the basic accounting principles concepts. Overview of what is going to be taught is meaning of accounting, definition, steps involved in accounting, and terms. Accounting terms have been dealt with, and meaning of accounts, meaning of definition, types of accounts, and rules of accounts is going to be explained in this video. The first one is accounting. What is the meaning of accounting? It is a process of recording financial transaction is pertaining to any business. Any business has to maintain accounts, and the process is known as accounting. Summarizing, analyzing, and reporting these transactions to oversight agencies, regulator, and tax collection entities. These accounting details has to be submitted to the various parties which are keen of inside the business and outside the business. These account details has to be submitted to them. The financial statements used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operations, financial position, and cash flow. Next one, definition of accounting. According to American Institute of Certified Public Accountants, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transaction and events which are of financial character and interpreting the results thereof. From the definition, it is clear that the first step is recording has to be done, then classification and summarizing. Anything in terms of money, it has to be calculated and the results have to be achieved. And the next one is different types of steps involved in accounting. The first process of step involved in accounting is recording. Recording is nothing but day-to-day transactions are recorded in the day book, that is journal or subsidiary books. This is known as a book of original entries. So the first step is entry of data in day-to-day journals. Next one is classification. The process of grouping transaction or entities on a predetermined basis. That is, the transactions that are entered in day-to-day transactions that are entered in journals or subsidiary books are posted into ledger. And the third one is summarizing. Summarizing is done in a periodical manner and it has been done in either form of trial balance, trading, profit and loss, and balance sheet. This summarizing is done and it has been given to all the owners or any interested parties it has been given. And the fourth one is significant manner. The accounting process has to be done in a significant manner and it has to be followed the rules like debit the receiver and credit the giver. Everything has to be done in a significant manner. Next one is in terms of money. Any transaction, business transaction are to be recorded in terms of money only. And the next one is transaction events of financial character. Any transaction or events which are of in cash or credit, it has to be done in transaction of financial character only, it has to be recorded. Then the last one is interpreting the results. The results from the balance sheet has to be interpreted and it has to be submitted to the top management wherever it is necessary. Next one, accounting terms we are going to see. In that few accounting terms we are going to deal with. The first one is transactions. Transaction is nothing but an event or business activity which involves exchange of money or money's worth between the parties. Transaction either can be cash or credit. Payment in cash means the payment can be done either by cash or check. Credit transaction is nothing but payment is settled at a future date as per the agreement between the parties. The next one will move on to the goods and services. Goods means nothing but tangible articles or commodities are known as goods. And services means intangible services, in nature of intangible services. For example, if you are going to purchase any raw material, then it is a goods. And if you are going to avail any advertisement services, everything we are going to avail means that comes under services. Next one is profit. Profit is nothing but excess of revenue income over expenses is known as profit, and loss is the reverse of it. Excess of expenses over incomes is known as a loss. Next one, assets. Asset is a resource owned by the business for the purpose of generating a future profit. Assets can be tangible or intangible. Tangible asset is that it has physical existence. For example, plant and machinery, furniture and fittings, land and buildings, etc. Intangible assets is nothing but that does not has no physical existence. For example, goodwill, patent, trademarks, copyright, brand equity, designs, intellectual properties, etc. Even assets, tangible assets have been classified into two. They are current assets and fixed assets. Current asset is nothing that assets which are easily convertible into cash are known as current assets. For example, cash in hand, cash at bank, sundry debtors, etc. Fixed assets are those assets which have been used for long run in the business, like land and land, plant and machinery, furniture, etc. Next one, liability. It is an obligation of financial nature to be settled at a future date. It represents the amount of money that a business owes to the other parties. We are liable to pay amount to other parties because we have borrowed money from them. For example, if you take bank loan means then we have to repay the loan to the bank. So it is a liability of the company. Example, when a good has been bought on a credit means then we are liable to pay the creditors. So that is known as liability that the firm has to repay to the other parties. Next one, capital. It is the amount invested in the business by the owners. It may be either in the form of cash or goods or asset, whatever it may be. From business point of view, this capital is to be repaid. As a liability, it has to be repaid to the owner when it is settled or at the time of winding up of the company or firm. Next one, drawings. It represents an amount of cash, goods or any other assets which the owner withdraws from the business for his personal use. For example, to pay life insurance premium if the amount has been withdrawn from the business or firm and it has been paid to the life insurance corporation, then it is treated as drawings. Drawings will be reduced in the owner's capital. Next one, net worth. It represents the excess of total assets over total liabilities of the business. It is also termed as owner's equity. So the net worth is, if the net worth is more, then means the company is having a profit. If the net worth is less, means the company is incurring a loss. Then debtors. Debtors are nothing but it is the customers are known as the debtors. If they are not able to pay the cash means they will be known as the sundry debtors. They will be paying in the future also in terms of credit transactions. The sum total or aggregate of amounts which a customer owes to the business for purchase of goods on credit or service rendered. Their other names are termed as sundry debtors, trade receivables, book debtors and book debts. Debtors are those persons from whom the business has to recover the money on account of goods sold or services has been rendered on credit basis. They have to pay the amount at the future date. There are three types of debtors are there. First one is good debts. Good debts is nothing but we are sure that the sundry debtors will pay the amount to us at the future date. Doubtful debts is that debts may be recoverable or not recoverable, may be realized or not realized. That is known as doubtful debts. They may pay the amount or they may not pay the amount at the future date. And the third one is bad debts is that we are sure that the amount from the debtors will not be recovered or realized. This is known as the doubtful debts. Next, profit and loss or income statement. This account shows the revenue earned by the business and expenses incurred by the business to earn that revenue. This is prepared usually for a particular accounting period, which could be a month, quarter, half year or a yearly basis. The net result of the profit and loss will be showed as profit or loss suffered by the firm. This net profit will be added to the capital account. The last one is balance sheet. In this statement, it is a statement of financial position of a business entity on a particular date. To know the financial position of a firm, we can have a look over the balance sheet. It lists all the assets, liabilities and capital. There is an accounting equation that asset is equal to liability plus capital. That means all the assets will be equal to liabilities to be paid to the other parties plus capital. It is important to note this statement. I exhibit the state of affairs of the business as on a particular date only. Next one, we move on to the meaning of accounts. An account statement is a ledger which records a transaction relevant to a person, asset, expenses or profit named in the heading. Accounts may be divided into personal account and impersonal account. Personal account that deals with the persons only. Impersonal account that deals with goods or expenses or incomes. Impersonal accounts can be further divided into real accounts and nominal accounts. These are the types of accounts. Accounts has been classified into two, personal accounts and impersonal account. And impersonal account is again classified into real accounts and nominal accounts. Personal account. This account relating to person or group of persons in institutions, companies, firms, etc. are known as personal account. For example, Raman's account, Raman's capital account, Bank of India, State Bank of India account. Anything comes under the name of any person or institution, then it is known as personal account. Next one is real account. These accounts relating to properties are known as real accounts only. Example, furniture account, machinery account, buildings account, etc. And the third one is nominal account. The account relating to expenses and losses, incomes and gains are known as nominal accounts. Example, wages account, discount account, rent account, salary account, commission receipt account, etc. The rules for accounting. These rules are known as the golden rules of accounting. Based on the types of accounts, these rules have been framed. That is, for personal account, every debit, there are two aspects are there, debit and credit. For personal account, debit is debit the receiver, credit the giver. Real account, debit what comes in and credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. In a double entry system, there will be a debit and a corresponding credit will be there. There's a principle that for each and every debit, there's a corresponding and equal credit and vice versa. That means every debit transaction has to be tallied with a credit transaction and debit and credit must be balanced equally. Thank you for watching this video. Thank you.